Personal finance presentation. Financing personal expenses. Prepare to get financially fit by practicing personal finance. When we're thinking about the expenses that we're going to be consuming within our normal operations, within our normal personal spending, it can be a little bit confusing in terms of how we're going to finance or what are going to be our financing options in order to make those personal expenditures. We can look at this as a similar question that we might ask from a corporation or business side of things, noting that it's going to be a little bit different due to the objectives of the business versus our personal objectives, although there are similarities as well, and we can look at the good old accounting equation to think through that. So this is the accounting equation from an accounting standpoint where we have the two balances of it, the assets on the left, and then who has claim to those assets, liabilities, or in essence us, the net worth on the right. When we look at it from a business standpoint, the business is there in order to have revenue generation. The assets that we have on the books are not there from a business standpoint in order to just compile the assets. We have the assets there from a business standpoint to help us to generate revenue in the future. We're going to consume them in part in expenditures in order to generate revenue in the future. That's going to be equal to liabilities and what would be called equity, or in this case, we're going to call net worth, which would be the flip side of the assets, meaning who has claim to the assets, or we can think of it as how we are financing the assets that we have. How are we financing those assets that we're using in order to generate revenue in the future? We're either financing them through the liabilities, through third party, things like loans, or we're financing them from the owner or continued growth in the company through our own basically earnings that are happening within the company. Same kind of concept on the personal side of things. The only thing being different is that the assets over here, of course, on the left-hand side, don't represent things that we're using for future revenue generation necessarily. We have the assets on the left-hand side, things that we have not yet consumed that which have value that might be used for revenue generation, but are also just being used in order to consume for general well-being for ourselves. So we got the assets. How do we finance then those assets? Either we do that with the liabilities or with basically the earnings that we're going to have with regards to the net worth that accumulates over time. Now we can run this same accounting equation this way, rewriting it algebraically. Assets minus liabilities equals the net worth, meaning, of course, the assets is what we have. The liabilities are what we're going to be third parties claim, and the net worth then being our net value assets minus the liabilities. So if we have the expenditures, looking at this accounting equation, there's really only two areas that we can take the expenditures from. We're going to either be taking them out of the assets that we had generated over time, or we're going to be taking them by increasing the liabilities that we have. So either the assets are going to be going down, typically the liquid assets like cash, in order to pay for the expenses, decreasing the assets, which would decrease the net worth, or we're going to say that the liabilities are going to be going up, and the liabilities going up would decrease the net worth. Or in other words, if we look at the accounting equation down here, when we're paying for our current expenditures, either we take the cash that we have, we spend the cash for the current expenditures, which would decrease the assets. Assets minus liabilities means, of course, our net worth would go down, or we're going to be financing it in some way, possibly with a credit card or some type of loan, which would increase the liability, which of course would mean that the assets minus the liabilities would result in the net worth then going down. So those are our general two options, of course, for our normal kind of financing options for our expenditures going forward. They both have a decrease in the net worth. So how might we want to think about that? Obviously, if we have the cash that is available to cover our current obligations, it would be useful to have enough cash in order to do that, because although that's going to decrease our net worth as we make the expenditures, by not financing, we're going to avoid future costs of financing, which is the rent on the money, which is going to be interest that will be involved. So the liquid assets that we would need, which is of course why we would want some portion of the liquid assets. And remember, when you're thinking about the assets up top, you're thinking about having enough of these liquid assets in order to pay for the current expenditures, because you're trying to avoid increasing financing from liabilities. Because if you increase from liabilities, then of course you're going to be incurring the interest on that. But we don't want to have all of our assets in liquid assets because they're not going to be helping us to generate income. So we have that balancing act that we're going to be having here in terms of we would like to have enough assets in order to basically have our assets working for us, giving it some type of return, putting them into stocks and bonds or some types of investments that are working for us. But we also need enough assets to be covering our current expenditures as well as possibly the emergency expenditures so that we are not in a situation where we cannot access the assets that we have and therefore need to have the liabilities. If we don't have the sufficient assets at this point in time, which is quite, often the case at different parts of people's lives, then we have to go to the financing from the liability side. Then the question would be, well, how can I finance? What's the best option to finance on that side? So obviously, if we have the assets, we would like to manage the assets to have the checking account covering the current expenditures plus the emergencies, the savings account there that's pretty accessible liquid assets. And mutual funds are also fairly liquid because we might not be able to dip into a mutual fund immediately, but if we make the trade within a relative time, we can get to the money. Now that's different than a mutual fund, remember, that's under the umbrella of an IRA or some kind of retirement account. If it's in an IRA or a retirement account like a 401k plan, then it is more difficult to access. And if we were to access, we're gonna incur penalties and interest, which may be higher than what we would be paying if we had to take on debt from like a loan or something like that. But if it's outside of an IRA or mutual fund and we don't have any penalties, although we still might have to pay capital gains or something like that, then we can at least access it not as quickly as the checking account, but we have then still some liquidity to it. Then, of course, if we can't pay for something, the current expenses with the current assets, then we can finance with the liabilities. That would be our next go-to point. And then the question is, well, what's the best format to finance with the liabilities? We got the credit cards, an advance, or something like a personal loan. Now, of course, the credit card, if we pay off the credit card immediately, if we're going to say, I'm going to finance it right now and then possibly sell something like the mutual fund or something like that, so I can pay off the credit card at the end of the month, we might not be subject to basically any interest charge or anything, any of the rent on the money, and that would be the cheapest way to go. Clearly, if we're not able to pay it off at some point in the future, then we need to be measuring the cost of the renting of the money, the renting of the purchasing power, comparing different credit cards and whatnot in terms of what their fees are going to be to make sure we're in compliance, watching the credit scores, and then thinking about, is it possible for us to consolidate our credit in a better way, possibly taking something like a personal loan out or something like that, if we can get a rate that is better than the credit card rate, or possibly a rate that we can lock down as opposed to having a rate that can fluctuate with the economy, going up and down with the economy. And then, of course, are there types of loans that we might be able to take, such as if you own a home, is it possible to consolidate in such a way that you can get a tax break on the interest? Because if you can deduct the interest, then in essence, you're paying a lower amount of interest. So that would be the next series of questions that we're going to do. So obviously, once again, personal finances, we really only got kind of the two options, but it can be still somewhat confusing to think about, the difference between those two options. So clearly what we would like to do is be able to be making our current expenses out of the liquid assets, hopefully having enough to do that if we're at that point. If we're at a stage in our life where we don't have the liquid assets, we would like to be able to be financing our current purchases in as cheap a way as possible, lowering the interest as much as possible, either financing with something like a credit card, but paying it off, making sure we have a plan to pay it off, or if we're having those outstanding balances for a longer period of time, having personal financing, possibly looking for financing where we can get basically a tax benefit of it. And if we're in a situation where we need quick cash and we have to take short-term kind of loans, then we have to do that. But obviously that would mean that we're going to have larger interest payments that we're going to be paying in on it. We would like to consolidate those loans as soon as possible into something that we're not going to be paying as much of the interest on.